Good afternoon and welcome to HYCM's FX Week Ahead webinar with myself, Giles Coughlin. Good to have you on board with us for the next half hour. We'll be looking at some of the most significant market events that we've got coming up. And it's been a very interesting time in the markets, particularly at the end of last week, at the start of this week. We're seeing some really big moves, which is quite strange for a sleepy August, when we should be having smaller ranges and smaller volumes. We're seeing a sudden pickup in activity. So I'm looking forward to taking you guys through that for this coming half hour. Just as folks are coming in, be good if you could just let me know if you can hear me okay and make sure I'm coming through. Oh yeah, hi Nadir, thanks for that. That's great. Hi Van, good to have you two guys here with us, and looking forward to coming through. Don't forget, you can use the question and answers panel, and if you put a question into the panel, I can get to it by the end of the webinar, so if not before. So feel free to type your questions away there. And I think I think Marcus, this is your first time. Hi Marcus, nice to have you with us for the first time as well. So okay, just to make it clear that as I'm going through different scenarios, it's not trading advice. This is all about education. The idea is you look at some of the upcoming market events and you see how stand these market events. I put the framework in place and then I use that to make my trading decisions. So the idea is education for you to begin to make your own trading decisions, and so you can trade with more confidence and more assurance of what the currency market should be doing in certain situations. So that's just to make that clear as we get going. And don't forget as well, tomorrow we got the FX webinar workshop where we take a couple of market sessions and see what's going on. Okay, here we are. We're going to get stuck in. We are very firmly in a risk-off market mode. The scenario of Monday morning, and it was coming into the end of last week. The US-China trade war has been in the background continually, since the end of 2018 December. It's when President Trump really stepped up the ante against China and the introduction of tariffs, and all of a sudden Trump has suddenly stuck back in. It was Friday of last week, and the trade talks had just started between US and China. They just got face-to-face talks going, and they seem to be going pretty well. Then all of a sudden, Lighthizer and the other US delegation went back to President Trump once the talks had finished, and they said, the Chinese aren't budging on certain issues, and President Trump kind of lost his rag and announced a fresh set of tariffs, a 10% tariff on the remaining $300 billion of Chinese goods to the US, due to come into play on the 1st of September. Now, that obviously was concerning, and we've had China stipulate that they're going to strike back to the US. So the trade war is really back on, and markets are understandably concerned. So what we see in these safe haven risk-off modes, what we see a typical safe haven reaction when we see strengthening yen and Swiss franc and strengthening gold. And that's exactly what we've been seeing over these last few days. We're seeing strong yen, strong Swiss franc, and strong gold. And so, that's helpful because, as for you guys, Van, Nadir, particularly you follow the webinar, you know that, okay, that gives us two strong currencies. So we know that the yen and the Swiss franc, as long as this US-China trade war antagonism is remaining, as long as this risk-off tone is in the market, we know that the yen and the Swiss franc are going to remain bid. So we already have our strong currencies, and we also have one strong commodity, which is gold. So those two currencies, one commodity, we've got some strength there too, which is helpful preparing it against weaker currencies and weaker currencies. Now, here's a little cheat sheet for you guys, and this is just such a good example of a risk-off mode. I wanted to start the week ahead with a little bit of background. One of the helpful things about trading the FX markets is different markets can give you trading opportunities in FX. And basically, in a risk-off mode, which is, there's a table here basically. On the right-hand side of the table, you can see this is the characteristics you get in a risk-off market. So you get higher volatility index, you get stocks falling, which is what you can see. Can you see here on the right-hand side? You can see here, I came to my desk this morning and I saw that the Nikkei was down nearly 2%. Anytime the market's down a percentage point, anytime the equity markets are down a full percentage point, you want to take notice. And the Nikkei is down nearly 2% at 1.74%. The Shanghai was down 1.62%, and the Hang Seng was down 2.85%. So these are large, heavy equity losses. Okay. Now you can also see the futures market at the time that I took this screenshot. The S&P 500's future market was down 1.48%. It's currently down 1.47%, and the Dow futures market is down 0.37%. And it's currently down 0.64%. So when you're putting that together, you can see the European equities, a sea of red. Okay, and the volatility index is really high at plus 21.52% increase. Okay, so here you can see this is a typical risk-off environment. We've got the higher volatility index. There it is, 21.52%. We've got stocks falling, the Nikkei, the Hang Seng, the Shanghai, all the European bourses. We've got bond prices rising. Now, the way to understand bond prices is when a bond price rises, its yields fall and vice versa. Okay, so you can see here, these are yields, bond yields. You can see US 5-year, 10-year, 30-year yields falling. European bonds, got the German, the French, the Italian, the Portuguese, and the Spain bond all falling. Okay, so this is just this is a perfect example of a risk-off market environment. And in these environments, it has the same kind of effect because traders are rotating out of equities. And the way this works is equities are more risky assets. Okay, so when you have these risky assets like equities and the market's concerns uncertain, investors pull money out of the equity markets. So money goes out of the equity markets and it starts to go into things like bonds. Okay, so that's where you have the bond prices rise and the yields falling, because there is an argument. There's a school of thought where some people say you should either be in, you should be either completely in equities or completely in bonds. Okay, because they're kind of, when a country and economies expanding and growing, you want to be in equities. When it's times of uncertainty and contraction, you move out of equities into those bonds where you preserve your capital and just get a guaranteed return. So it's, you do better than just leaving your money in pure cash. So that is the correlation that's going on here. So as long as this situation remains, as long as there's uncertainty from President Trump and the Chinese side, as long as that antagonism keeps going, and the first sign of a change will obviously be the equity markets. If these equity markets start picking up, that will give you an indication that we're moving out of a risk-off environment. So as long as the equity markets are falling, we know that we're in a risk-off scenario. So we see yen strengthening, the Swiss franc strengthening, and we see commodities like gold appreciating. So just very briefly, looking at, I'll just take that down. I'll just very briefly look at some of the yen pairs, and you'll see what I'm talking about here. Here's pound yen. You can see with Brexit concerns and the yen strengthening, from last week, you can see, look how far it's fallen. So 1, 2, 3, 4, 5, 6 out of 7 trading days, we've only had one day which it made an increase, and prices just sliced through the pivot points you know, very, very clearly. Again, weekly, you can see just solid weekly selling straight through one pivot point down to that pivot point there, just finding a little bit of support there. And it's, you know, it's be the same for, you know, all the pairs. You can see, okay, Swiss franc here, and really appreciate, you know, really Swiss franc's appreciating strongly against the pound, just moving through that support pivot point there and looking to move down. So, you know, trades that we should be looking at for this next session are obviously things which are pairing with the yen, the Swiss franc as the strong currency. So that's just to make that clear. Now we get into the week ahead, just to see what opportunities we have. So we're still expecting to find sellers for the pound on chance of a no-deal Brexit increasing. Okay, the situation with the UK politically is intensifying because Boris Johnson has sort of promised the UK country that no matter what happens, Britain is either going to leave the EU on the 31st of October with a deal or without a deal, but either way it's leaving. So he's given an ultimatum. Now there's some debate going on in the UK at the moment about whether Boris Johnson can be stopped from taking Britain out of the European Union. And you know, analysts are unsure as to whether it's even possible because there's some time constraints on Parliament. UK Parliament is now on a summer break and won't be back, I think, to the 3rd of September. So some ministers, there was a senior UK minister who said that it's impossible to stop a no-deal Brexit now. And there's been some debate in the UK whether that is actually the case or isn't the case. But either way, the chances of a no-deal Brexit are increasing. So that's why we're seeing further weakness in the pound, and any upticks in the pound, like we got today with the UK services PMI, I'm expecting to find sellers on you know, pullbacks to resistance levels. Again, we're expecting weak pound and strong US dollar. Expecting the dollar to remain strong as the best of a bad bunch, because you know all the major central banks are looking at cutting rates now, with the exception of the Bank of Canada. So we have the Bank of Australia and the Bank of New Zealand meeting this week, and the expectations are that they will be indicating a more dovish perspective, particularly with the global concerns that are happening at the moment. So, you know, pound US dollar pair is one pair I'm looking at. I'm also looking at the euro US dollar pair. Now this is a trade that I'm in. I'll just show you that now and my reasonings for it. Again, this is not saying you should be in it. I'm just explaining my reasons. See what you got here in the euro US dollar pair is I'm expecting, you know, this pullback into this pivot point here. That for me was the initial reason for me to get short, and I'm just having my stop above this resistance point up here, because if price breaks through there and there, that tells me that I'm wrong. And this pivot point here, the reason I'm shorting the euro US dollar pair is Eurozone, economy slowing down. The ECB are expected to be cutting interest rates in their September meeting. They may be introducing a whole set of different criteria to add quantitative easing to the country, tiering deposits to allow for negative interest rates from the ECB itself. The whole sort of swathe of things they're looking at doing. Was the US dollar I'm seeing as the US economy is doing quite well. The last Fed meeting was more optimistic than the market was expecting, so I'm expecting to see some US dollar strength come into the market. That's my entry, and I've just got my stop just above this R1 resistance level, and obviously looking down for a play down to this support 1 level, down at 1.0, just 1.10, that kind of region there, just going down to that level. So that's what I'm looking at. Let's now look on the calendar to see what we've got coming up. And the first thing I've got up there is the RBA rate decision, but I want to show you something else first. And this was the services PMI data we had out. Okay, so I had this flagged as a potentially a good time to short. Okay, because you know, a good number for me was a good opportunity to short the pound. This is called fading the sentiment, when you get you know, a strong reading, that's a relatively strong reading for services PMI. It was the highest reading in about 9 months. It's not brilliant. It's still not great for the UK generally speaking, but it's a slight upbeat. And the pound was bid on that more optimistic, you know, services PMI. Services PMI is very important for the UK, and you know, it's still sustaining at the moment. So, you know, a pound-yen pair, for instance, you know, looking at the pound-yen pair, let's just go, you can see that you know, you can see, okay, you've got, you know, you've got some, we saw this, you know, sort of recovery moving up here into this resistance point there. Let's put it onto the 1 hour chart. You can see there. Okay, so there's some temporary resistance, and then you can see like a breakdown of this level. You can do a trend line there, a breakdown of that level, and we may be seeing more downside there. So that's one pair that I'm looking at the moment, pound yen, and obviously just that services PMI data was a little bit more, you know, optimistic than people were expecting. But again, I'm not expecting a prolonged rally in the pound. It's just opportunity to short the pound at a better level is the perspective that I'm seeing it from. Obviously, any positive Brexit news would change that, but at the moment we're still expecting negative Brexit news. Non-manufacturing PMI out. Obviously, the Federal Reserve has moved to a more data-dependent footing. So obviously manufacturing is important for global growth concerns, so that will be eyed. And the New Zealand dollar is under focus this week. We've got some employment change, unemployment rate coming out. Now the RBNZ is expected to cut rates at this meeting. So a poor result here would result in some early New Zealand dollar weakness. So that's just something to be aware of. You know, a very poor data point out of New Zealand would, you know, add to that, not only cutting rates, but a more dovish picture from the RBNZ. So that's okay today. Now let's look at the, you know, significant event is the cash rate decision and the rate statement at 5:30 a.m. GMT, Tuesday, August the 6th. Now, what the RBA have had recently, they've had 2 back-to-back rate cuts, and they're expected to stay on hold for this rate meeting. Now, as I was preparing, you know, for this rate decision, I noticed that the Reuters poll, there's only 2 out of 40 analysts who see a 25 basis cut to 0.75%. And the picture for the RBA is mixed because the labour market has shown strength, which is important for the RBA, and inflation's picked up a little bit, but the US-China trade dispute flare-up has hit the Australian dollar hard, and there's more potential for downside if Trump continues, you know, his combative approach. So if there was a surprise rate cut tonight, we'd see a quick and sustained Australian dollar selling. So the thing to be aware of going into the Australian dollar, you know, that rate meeting, you know, that can be worth staying up for, because if you get a surprise rate cut, and it's possible because, you know, there has been a flare-up of this US-China trade war. We know that the Australian dollar is particularly hit hard by US-China trade war because 30% of Australia's GDP is generated from trade with China. So what's bad for China is bad for the Australian dollar. So that's going to be putting more pressure on the RBA. So just to be aware of that, even though the market's expecting it to be on hold, you know, there's greater chances of a rate cut, and the rate statement, you know, may indicate that. Might say, okay, we're staying on hold, but we're going to definitely cut rates at the next meeting, or, you know, they might give a clue. So there's potentially a trade there. So look out for something that surprises the market, and the market is moving heavily, so we could expect some surprises for sure. Then the next one to really look at is another Antipodean currency, the New Zealand dollar. We've got the official cash rate. That's, the cash rate, official cash rate. This is just interest rates. It's different words for the same thing. And the RBNZ are expected to cut interest rates. This isn't a surprise really at all. The business picture in New Zealand is subdued. Business confidence is still low. What will be key for the New Zealand dollar will be the rate of cuts. Okay, so if the rate of cuts is, faster or slower than the market expecting, that's what's going to drive the New Zealand dollar. So look at the rate statement and look for clues. The rate statements often give clues. We're expecting we'll be cutting rates faster than we expected, or not as fast as expected, and the New Zealand dollar will be moving on the back of the rate statement. So that's a rate statement to look up for. It is worth staying up for again. It's another potentially good opportunity with any unexpected decision from the RBNZ. We'll move that, but the expected decision is 1.25%. So after that rate cut, the market will then digest the rate statement. But again, remember the press conference afterwards. So you've got the press conference an hour afterwards with all these events. Whenever there's a press conference, you have to be aware, because the governor can sometimes either amplify something in the rate statement or contradict something in the rate statement. So you've always got to see the events as one event rather than, okay, I've seen the rate statement, I've seen the cash decision, and I'm just going to leave it. No, always wait to see what the governor says. So that's Wednesday. Thursday, there isn't anything particularly of massive impact for Thursday. Friday, we've got the RBA Governor Lowe speaking and a monetary policy statement. So those two events, again, are risk for the Australian dollar. And we have GDP and manufacturing production out for the pound. Again, not expecting anything wonderfully market moving here. However, if these figures are bad, they'll start to weigh more heavily on the pound. So if these figures are good, then expect the rallies to be sold. If these numbers are bad, then people are going to get more spooked and concerned about Brexit and how it's weighing on GDP. Big problem for the UK is investment. With so much uncertainty going on around Brexit, this idea of the investors are holding back from Britain because of Brexit. Anytime that starts to be seen in any data, manufacturing, GDP will weigh on the pound as well. So that's the way I'm looking for that. Canada, again, don't forget with Canada, the Bank of Canada is the only major central bank that hasn't officially moved to an easing bias. They're not officially cutting interest rates. So that's why the Canadian dollar could be supported. But remember, the Canadian dollar is very, very closely correlated with oil. So the weakening oil markets, and the reason the oil markets are weakening at the moment is commodities as a whole. When there's concerns about global growth, that hits commodities. So, notice we looked earlier, didn't we? We looked at the commodity list. Okay, look, these are called, crude oil down, natural gas down, copper down, aluminium down, iron ore down. The only commodities that were up was gold and silver because they're safe havens. Okay, the rest of the commodities were down because if you think about it, they're the commodities that are used for building. If you want to have a new building, you've got to have copper wires, haven't you? So you need to have all that copper, all the base metals that you need for technology. So if global growth is slowing down, then there's going to be less demand for all of those commodities, and so the price falls. Okay, that's the relationship. In a very simple way, that's what's really going on there. So just to be aware of that dynamic. So the Canadian dollar, return to the Canadian dollar point, the Canadian dollar is closely correlated with oil. So although it's a major central bank that hasn't officially moved to an easing bias, the Canadian dollar is still under pressure today because of falling oil prices. So just keep an eye on the oil prices for the Canadian dollar, and that is because I mentioned that because we have potentially some market moving data out for Canada on Friday. But don't forget, you need to look at the context at the time, how the oil prices are doing, what's the US-China trade situation like. So as long as the antagonism remains between US and China, yeah, the VIX. Yes, Sammy, that's a good question. Where you can find the VIX. Just had a question from one of the long-standing members here about finding the VIX, the volatility index.
Syrian army has
on,
resumed military operations against.
Sorry about that. I had my squawk on. You might be able to find it on TeleTrader. Let's have a quick look. I'll just have a quick look. I find this could be quite helpful from free information. I don't know if they've got the volatility index on here, Sammy. Let's have a look. VIX. The VIX is good. Like you've got commodity prices here, and you've got indices here, so that can be helpful. Let's just do a quick search and see if. No, let me think another place to try. Yeah, let's try TradeView, see if it's there. I'll just try this, and if I can find it here, great. Otherwise, I'll have to leave. Maybe some of the other guys can help. I think I've got it here. Right, here we go, Sammy. So we've got the volatility. You can find it on TradingView and just search under VIX volatility index. I think that's the one. Let's just check. VIX 2140. Where is this? 2120. 20. Yeah, that's it. Sammy, that's it here. I will put the link here on and send it to all. Okay, so that should be over to you. Yeah, that's great, Sammy. And you can use this volatility index, and you can use it as an indication of how the market is feeling. The market is feeling very concerned at the moment. Okay, so obviously you can look at key levels and you get hints and clues of what's going on. So any break above 23 is going to be significant. You can see, December 18, that's when the tariffs started to come in. We went as high up as 30, 35.8, 36.1, 36.2 or 3, and we're moving up to the higher range now already. So guys, that is our FX week ahead. So 2 big cash rate decisions, RBA, RBNZ. They are potentially really good opportunities, as well as the ongoing US-China trade concerns. We've got, yen strength, Swiss franc strength, and potentially some gold strength. So keep an eye on what's happening with the US-China issue. If Trump makes some conciliatory remarks, or China starts making some conciliatory remarks, expect those dynamics to change, and look at the equity markets as a good lead. So if the equity markets are still pressured, then we're likely to still see the yen, the Swiss franc being bid. Guys, I hope that helps. Don't forget, we do a training offer here. For those people who deposit $1,500 with HYCM, you get an hour coaching session with me. For those who deposit $3,000, you get an hour coaching session with me and trading follow-up review. And for those who deposit into their accounts $10,000, you get 2-hour, 1-hour follow-up and 1-week VIP, basically email support from me. Now remember, this money here is money you deposit into your own account. So this isn't paying for my services. This is just money you put into your account, and as an incentive, to do that HYCM offer coaching sessions with me according to these different levels. So that just hope that makes sense to you guys. And don't forget, we'll be here next tomorrow at 1 o'clock, 2 o'clock GMT, and we'll be looking at putting some more beef, as it were, on the bones of the market opportunities that that I'm looking at for the coming week. Guys, it's been a pleasure as always. Nice to have some of you new guys on board, as well as the regulars. Thanks for coming again, Van, Nadir, Sammy. Always a pleasure to have you guys. Welcome as well to you, Marcus, and Hashik and Latonya as well. I think you're new. Good to have you. Yeah, thanks, guys. You have a really good week, and I hope to see some of you tomorrow. And safe trading. Take care now, guys. Goodbye.